With home affordability at an all-time low, it's no surprise many would-be homebuyers are looking for ways to reduce their housing expenses. One of the best ways to do this is with a multifamily home, which is a 2 to 4 unit property where you can live in one unit while renting out the others. You can finance these properties using both conventional and FHA loans with as little as 3.5% down, making them easier to access than you might have thought. So I'm going to talk about how you can purchase a 2 to 4 unit home with an FHA mortgage while focusing on the basics of FHA financing, details when it comes to FHA financing on multifamily homes specifically, and how FHA loans compare to conventional loans in these scenarios. So let's talk about some FHA basics. So an FHA mortgage is a mortgage that's actually backed by the Department of Housing and Urban Development, or HUD, and it allows for someone who's purchasing a primary residence to have more lax credit guidelines when it comes to purchasing a property. Now, you don't have to be a first-time buyer, but you do have to be purchasing as your primary residence, meaning a home you're going to live in year-round. FHA mortgages have more lax credit guidelines because they allow for lower credit scores. So you can go as low as a 580 credit score. Some lenders will go to 500, but most will cap at a 580 minimum credit score for an FHA mortgage. They allow for higher debt-to-income ratios than that of a conventional mortgage. Conventional mortgages with excellent credit cap at about a 50% debt-to-income ratio, meaning the amount of money you make monthly compared to what your expenses are monthly, including the property that you're purchasing. FHA, on the other hand, will actually go as high as 57% for your total debt to income ratio, which is pretty substantial, of an extra 7% wiggle room of play. They also have more lax guidance when it comes to past credit issues such as foreclosures or bankruptcies or short sales, deed in lieu of foreclosures. There are a lot of people that experience those over the past, 6 to 10 years who want to still buy again. And so there's a shorter waiting period for those types of credit events when it comes to FHA financing versus the conventional options. Now, with FHA loans, you can finance all types of properties. You can do a single family home, which is a 1-unit property, a traditional house. You can do a condominium if the condo is FHA approved. So the project has to be FHA approved, or your lender needs to submit for a single unit approval for the unit you're interested in. Just a few extra steps versus conventional. You can do a townhouse, an attached property. And what we're talking about in this video is we can do multifamily properties, which are any property that's 2 to 4 units, right? You can't go above 4 units for residential financing, but 2 to 4 units would qualify for an FHA mortgage. Now, FHA loans, just like any type of loan, there are loan limits based on the county where you're looking to purchase. So regardless of where you are, depending on where you are, you have to make sure that you're staying within that limit. It's not your purchase price limit. It's the amount you can borrow as far as the loan amount's concerned using an FHA mortgage. And I talked about the credit scores being more lax. That's extremely important, and the debt to income ratio as well. Now, there's some common misconceptions when it comes to FHA financing. One of those, like I already mentioned, is that it's for a first-time home buyer. Well, that's just not the case. FHA mortgages can be for anyone purchasing a home, regardless of how many homes you've owned in the past, but it needs to be a home that you're going to live in, a principal or primary residence, a home that you plan to move into and live in for at least 12 months post-closing. And you're going to sign a document at closing, called occupancy affidavit, that's stating you're going to live in the property. So there's no trying to lie and say it's not going to be your primary. It needs to be your primary residence if you're going to use an FHA mortgage. Now, you can actually have more than one FHA mortgage at the same time. Now, to do that, you need to be moving at least 100 miles away from where your existing FHA mortgage property is located, and you need to be able to prove you have at least 25% equity in the property that you're departing in order to do that. And usually there has to be a good reason. So you maybe got a larger family, right? You had children, you got married, and your previous home was from when you were single. That would be a reason. Your family size has changed, so you need a larger home. You're moving for work, right? Those are valid reasons as to why you would need a second FHA mortgage and want to use an FHA mortgage. And a big reason when people are going FHA right now over conventional is because the interest rates on FHA loans right now, at least, are actually lower by almost a full percent than those of conventional mortgages. And, a big issue that you might hear is, sellers don't like FHA. Well, one reason why a seller may not like FHA that makes it different than conventional is that the appraiser is required to do a head and shoulders inspection of the attic. They're not climbing into the attic. They're not doing any of that, but they do have to look in the attic, which is something that you wouldn't see happen on a conventional loan. They'll also look at things such as rotting wood on the fascia board on the outside of the house. They'll mention that if the home was built prior to 1978, if there's any chipping paint, it needs to be fixed because they need to factor that it could be lead-based paint, right? That's important. Another potential issue with FHA, or why it has a stigma in some cases, is that there's flipping rules with FHA loans, meaning that if the current owner of the property, if it's not a bank, meaning it wasn't a foreclosed property, if it's not currently owned by a bank and is owned by an individual, if they purchase that property less than 91 days ago and now they're trying trying to flip it for a profit, well, that's not allowed with FHA mortgages. You'd have to wait till you're outside of day 91 or on day 91 in order to go ahead and move forward with an FHA loan. So that's really it. Outside of that, FHA is a fantastic option when it comes to financing. Now, when you're financing a multifamily property, in this case, anything that's 3 or 4 units, a 2 unit, we treat it the same way as a regular FHA loan. The difference being is we can actually take rent from the secondary unit based on the appraisal and what the market rent would be, and we can use that toward offsetting the new monthly payment on the property. So you'd actually qualify for a higher price point on a 2-unit property using an FHA mortgage than you would on a single family 1-unit property using the same FHA mortgage. Now, when it comes to 3 and 4 unit properties, we can do the same thing. We can use rent from the other 2 or the other 3 units, whether it's a 3 or 4, toward qualifying you for the higher price point. However, on a 3 and 4 unit property, it actually has to pass something called a self-sufficiency test. Now, a self-sufficiency test is pretty high to pass these days due to the higher cost of living and the higher interest rates. But what a self-sufficiency test actually does is, if let's just say it was a 4 unit property, it's going to take the market rent for all 4 units. Let's just say that each unit would rent for $1,000 based on market. That means that 1,000 times 4 is 4,000. Now, lenders need to factor in a vacancy of 25%, which means that we can take 75% of what that rent is. So if it's 4,000, we take 75% of that would leave us 3,000. In order for the property to be eligible for an FHA mortgage, that $3,000 of rent needs to be equal to or greater than what the payment's going to be on the property. So if the payment's $3,000, well, then you're fine. If the payment is $3,001, well, you're not fine, right? You get it? So if the payment exceeds that number I just told you, it does not pass the self-sufficiency test. And here's something that I don't agree with, but it still comes into play. Even if the intent is not to rent out the other units, and even if you don't need the rent from the other units to qualify for the mortgage, you still have to pass the self-sufficiency test if you're using an FHA loan to purchase a 3 or 4 unit property. So you want to keep that in mind. It's very difficult to pass right now with where rates are. So definitely consider that when you're utilizing FHA for the purchase, because you would want to use FHA if you only have 3.5% to put down. If not, you can look at a conventional mortgage as an alternative, especially with the changes that took place in late 2023, where you can now put as little as 5% down using a conventional mortgage for a multifamily property, where in the past you needed to put down between 15 and 25%, which was not really attainable for the average buyer, right? So just keep that in mind. You have an alternative, but you definitely want to try to go the FHA route if you can make that work first by passing the self-sufficiency test and qualifying, because you're going to get the lower rate, less money down. As you now know, owning a home might be more realistic than you previously thought before watching this video. And I hope you utilize the information I provided and subscribe for more homebuyer pointers and tips that will allow you to confidently move forward in your home buying journey. And don't forget to leave a comment below with any questions or comments about your own scenario. I do reply to 100% of the comments I receive.